Jordan Belfort, the Wolf of Wall Street, is known for being an expert at selling stocks, but his sales techniques also show how smart startups use patents to attract and lock down investors.
Well, reason for the call today, John, is something just came across my desk, John. It is perhaps the best thing I've seen in the last 6 months. If you have 60 seconds, I'd like to share the idea with you. You got a minute? Name of the company, Aerotine International. It is a cutting-edge, high-tech firm out of the Midwest awaiting imminent patent approval on a next generation of radar detectors that have both huge military and civilian applications. Now,
the first thing to note here is that Jordan generated interest in the company based on patent pending technology, which means they filed patent applications, but these patent applications have not yet been granted and are not yet enforceable. This leads into one of the biggest mistakes I see inventors and startups make, which is thinking they need to have an issued patent before they can start selling a product or attracting investors.
Right now, John, the stock trades over the counter at 10 cents a share. And by the way, John, our analysts indicate it could go a heck of a lot higher than that. Your profit on a mere $6,000 investment would be upwards of $60,000. And in the case of Aerotine, based on every technical factor out there, John, we are looking at a grand slam home run. 4,000, that'd be 40,000 shares, John. Let me lock in that trade right now and get back to you with my secretary with an exact confirmation. Sound good, John? Great. Bye-bye.
How'd you do that?
The best strategy from a business perspective is to file a patent application just before making a public disclosure, public use, or offer for sale of the technology, which is when patent rights start being lost, or before approaching investors. Also, to keep risk and cost down, filing an inexpensive provisional patent application is the best way to start the patent process, even though starting with a provisional patent application adds an extra year to the patent process, which adds a year before a patent will actually grant. It can be counterintuitive, but smart companies know that rushing the patent process to get an issued patent sooner is actually a bad thing and is not necessary to start attracting investors. Going back to the Wolf of Wall Street, the heart of Jordan's pitch is about investing in a company before it takes off and explodes in value. Something critical to understand about investors, especially early stage investors, is that you need to sell them on the explosive growth potential of the company. Investors know that investing in businesses early on is a risky proposition, and they do so wanting a large potential payoff for their big risk. Pending patent applications play perfectly into this narrative, while issued patents don't, which surprisingly means that pending patent applications typically have more value to an early stage company than issued patents, especially if you know how to properly market patent assets, as I'll explain later on in this video. While it may seem like just having a pending patent application is a weaker position to be in, it tends to be more attractive to early stage investors because they can think, hey, if I can invest now and they are able to get this important patent, the company is going to have much higher value and I'll get a huge return on my investment. This could be a great opportunity. On the other hand, when you have issued patents, investors will often think, well, this company has already reached its full potential with patent protection. There won't be much more upside when it comes to intellectual property. I'm not seeing a big potential return here to offset my risk. It's completely counterintuitive, but in my experience as a patent attorney, companies who don't get substantial traction with investors before their first patent applications issue as patents typically never get investors and ultimately fail. Yep, that's right. Having issued patents too soon is actually a huge red flag for a startup instead of being something positive, and is a major indicator of a company that is not going to make it. So then how do you properly time your patent application filings and market the progress of patent assets to attract and lock down big investors like the Wolf of Wall Street? The first principle is to start the patent process by filing a provisional patent application before making any public disclosures, public uses, or offers for sale of the technology, or just before starting to approach investors. Patent rights start to be lost upon a first public disclosure, public use, or offer for sale, so it's critical to file before these activities so you don't forfeit any patent rights. Talking with investors does not typically forfeit patent rights, but it substantially helps your pitch in a couple of really important ways. First, it allows you to assert patent pending status, which will increase the valuation of your company and also makes it generally more attractive to investors. Also, the priority date established by your provisional application allows you to talk openly about the technology, which is pretty much essential if you want to give investors enough detail about what you're doing and developing so they can decide whether it's worth investing in or not. Also, it makes it so you can go into a pitch meeting without thinking you need the investor to sign a non-disclosure agreement. And hopefully it goes without saying, but most investors would be insulted by being asked to sign an NDA and would see it as a sign that you don't know what you're doing. So how do you market your provisional patent application like the Wolf of Wall Street to make it most attractive to investors? The first thing is that you don't need to be heavy-handed about it and can just mention that the technology is patent pending or that you've filed one or more patent applications. It's best to keep it broad like this and not say you have a provisional patent application, because while it's completely untrue, some investors incorrectly believe that a provisional patent application is somehow not as good as the full expensive non-provisional patent application. This comes from the reality that some folks file terrible provisional patent applications that are completely worthless, which is why you need to make sure you have a solid provisional patent application in place that will hold up to scrutiny when the investors ultimately look at it. For example, a provisional application you filed yourself or through a cheap service like LegalZoom is not going to cut it and is going to show that you don't know what you're doing. That being said, spending a ton of money on a provisional application is not necessary or even a good idea. And one of my favorite ways to keep costs as low as possible is coaching clients on how to draft a detailed disclosure of the invention that will look good to investors and then scrubbing and filing this invention disclosure as a provisional patent application. This gives the highest ROI while also keeping costs as low as possible. Where a more detailed discussion of provisional patent applications is required, startups typically fail to harness their inner Jordan Belfort to market them correctly and sell the multiple benefits they provide. Surprisingly, investors are rarely patent savvy, and giving them some education on the full power of provisional applications helps illustrate the growth potential that your company actually has. For example, a summary like the following is typically what I suggest. Our provisional application gives us an early priority date for our technology and preserves the option for filing patent applications in nearly every country worldwide for a year. Starting the patent process with a provisional application allows us to cost-effectively and incrementally protect our technology. Provisional patent applications expire 1 year after they're filed, which is when you need to file a non-provisional patent application. A lot may have been changed or added to the invention in the year since the provisional was filed, and you can add and protect these new details by including them in the non-provisional patent application. 6 months after the non-provisional is filed, which is 18 months from when the provisional was filed, the non-provisional application will be published and become publicly available. This publication is an important event in the patent process that most companies rarely use to their maximum benefit. First of all, publication can be a great press release or social media post that helps brand your company as an innovator and can generate buzz around the company. It reminds investors, customers, partners, and employees alike that you are building patent-worthy products along with valuable patent assets to back them up. For competitors, it sows fear, uncertainty, and doubt, and can help deter their entry or expansion into the market without having to ever enforce your rights. Also, because a published patent application looks extremely impressive and it looks nearly identical to an issued patent, most folks will assume that this means your application was granted, even though it's still likely pending and examination has not even begun yet. In addition to publicizing publication of the application when it happens, including the impressive looking first page of this publication in marketing and pitch materials where you mention patents is an extremely powerful visual aid. Examination will typically begin then within months or years and begins in negotiation with the patent examiner at the USPTO, where they need to be satisfied that the invention as claimed is new and non-obvious over the prior art. And if so, the application will be allowed and then will issue as a patent several weeks after you pay an issue fee. Publicizing allowance of the patent application and then subsequent issuance can be a great marketing opportunity, similar to the publication of the application, and the front page of the issued patent gives you a new impressive image to use in place of the application publication. Again, it's surprising how few companies actually take advantage of these important opportunities to market to investors, customers, and partners, along with passively deterring competitors. Before I get into some really big secrets and hacks, if you're getting some value out of this video, take a second to click the like button. It really helps the channel out. When selling the power of their patent portfolio, folks typically focus on the primary exclusionary rights of a patent. That is to exclude others from making, using, selling, offering to sell, or importing the claimed invention into the United States, or practicing a claimed method within the United States. But there's an important passive benefit of patents and patent applications that folks often don't know about or overlook, highlighting as a major benefit of patent assets. And it's two words: prior art. Once your patent application publishes 18 months from its earliest priority date, it can be used as prior art against other people who are trying to patent similar things, but who file later. This is true even while the patent application is pending, and even if it never issues as a patent. This is an important benefit of your patent portfolio to message to investors and partners, because a major concern is having a competitor get a patent that covers your core technology. It can be a major selling point to know that your patent assets passively do this without active enforcement, and even if your patent applications are pending or never end up issuing as a patent. Along with knowing what's important to say about your patent assets, it's also critical to know things not to say that can get you into loads of trouble. One of the biggest mistakes that I see people making is saying that they have provisional patents. And this video explains in detail why you never want to say provisional patent and why this seemingly innocent term can get you into tons of trouble.